What's going on, guys? It is Friday night and we are closing out week 10 of investing on our channel, where we invest $50 a day every Monday through Friday through dollar cost averaging. I'm going to get it right out of the way. Ouch. This is a rough week for us. This was a rough week for everyone and a rougher week for Charles Schwab. It sounds like this kind of, you just got to say, ooh, child, things are gonna get easier. Ooh, child, things will get brighter. Oh, keep your head up. Sorry about that, but that is what you gotta say to yourself, because wow, this was pretty terrible. But I'm being optimistic because we are bearish in this market, and we understand that the market is going to collapse, or at least we think so. That's why we're dollar cost averaging. And we are buying it every day as it gets cheaper and cheaper. Investing is not supposed to be a sprint, guys. It is supposed to be a marathon, or at least in my personal opinion. However, I'm not a financial advisor, wealth manager, or credit counselor. I'm just a dude in a triangle-shaped room ranting on the internet. But with that in mind, right, we started this channel 10 weeks ago. All right, so it's not like we have a lot to lose. The market's coming down. We're buying it as it's coming down. Eventually, it will go up. It might take a couple of years, but that's okay. Just means we'll be buying a lot while it's down, and that is a great place to be. Most of our stocks are dividend stocks, so we're going to be getting paid out on those as well. Hopefully, most likely, hopefully. So let's take a look. We're going to jump into our channel tracker. We're going to see what that looks like. We're going to take a look at some investments and some big losses. Thankfully, we don't have Charles Schwab, or it's not Charles Schwab, it's just Schwab. We don't have Schwab in our portfolio as a company, thankfully. Nor did we have that random bank in San Francisco that just closed and now everybody's scrambling. But we'll not get too much into that. Let's stay positive. Hold on, here we go. All right, so this is our YouTube channel tracker. On this highlighted blue line, you can see that it is March 10th of 2023. My weight is currently 286.4 pounds, so a little better than last Friday. Total weight loss of 12.3 pounds. Our investment balance is $2,740.74. So a little better than it was Monday, but we invested so much money in the meantime, so that really hurts. Dividends earned, we had a couple small payouts. So we went from $6.10 to now $10.73. We have quite a few more stocks and ETFs paying us a dividend this month, so that number will continue to grow throughout the month. And our total growth is negative $223.65. Ouch. Just to run a little calculation here, 223.65 minus 94.75. Yeah, we lost an additional $128.09 from Monday night until Friday night. That's really bad. But that's okay. So, we buy stocks that are pretty good. We got one stock that's a little volatile, and it's being volatile. So that it is kind of what it is. But YouTube income, we're still at that $100 total. Waiting to get monetized. We're pretty close, so hoping to get there soon. Total subscribers, we are at 1674. Thank you for the new subscribers. I appreciate you. Total view count, we're at 166,126 total views on our YouTube channel. So again, thank you everybody for the continued support. And our total watch hours is 3,410.1 of watched content. So, for everybody watching these more analytical videos, I appreciate you. It helps me a lot. Hopefully it helps you. And, clearly it didn't help MPW. I still think it's coming back, but anywho, we'll leave that for another time. So this is kind of where we're at. That's what's going on. Good growth in the dividends earned. It's good to see dividends still paying out even while stocks are tanking. To the people joining the channel, thank you again. I appreciate it. And back on track in the weight loss department, so that's good. Because we're about happiness, health, and wealth here. Wealth's a part of it, but health is another. So what we're going to do now, I'm going to dive into my SoFi account. Instead of looking at Seeking Alpha like normal, I want to look at SoFi just so we can lay out some of the losses a little bit better. I kind of like how it shows how terrible things are going right now. So we're going to take a look at that and, bounce around. Keeping your head up. All right, guys. So here we are in SoFi. It's a bad story, dude. It's not great. I mean, just looking at the year-to-date chart, we have growth, very continual growth, and then it starts sort of plateaus out, and then oof, oh man, it's really not the curvature you want to see. Anytime you're putting in $50 and then your account drops, it's just so disheartening. But that's okay. Here are those numbers that we were talking about before. That's our total gains. Our dividends are helping us out a little bit, but not really that much. But I want to come down here and look at the investments because this is going to paint a pretty strong picture here, guys. We have NASDAQ, right? NDAQ. NASDAQ, we have a couple shares. We're not buying this on the daily as part of the portfolio. This is just in there, but that just got crushed, like totally crushed. We got JEPQ, which is JP Morgan's Equity Premium Income ETF. It's basically a fund designed to pay you out a monthly salary. I mean, this took a hit today. This was actually about even for us, which, now it's down a little bit. This has actually been our best performing fund, and it's a fund that we aren't buying daily. So it might be time to start buying this daily. I'm not sure. It's brand new to the market. It started like less than a year ago, which is very, very new for an ETF. But it's paying great, and it's basically holding its own, which is awesome. And then this is public enemy number one right here. We have MPW, or Medical Properties Trust. So we have 20.8 shares of this. It's our highest shareholdings in the portfolio, and it just bombed. So we're going to take a look at this right here. Here we have Medical Properties Trust down 8.25% today, which is just, it hurts my soul, but it's okay. This week, down 17.1% on the week. So yeah, if you're looking at how, what's a big loss, we're down $66.93 on this all time, which is a pretty big hit. But we lost $1.82 per share times 20 shares. I mean, that will definitely negatively impact the portfolio. That's this week, guys. This week, 17% loss on one stock this week. That's like nutty. And to be honest, it's not even as bad as some of the other stocks. But that's definitely by far the worst of what we're holding. But a lot of financial stocks and banking stocks just got massacred today. Our total return on this over here on the right-hand side, we are down 26.77%. So, getting absolutely crushed with MPW here. And, month to date, down 25.82%. So just in this 1 month makes up pretty much all of the negative return of MPW that we have in this portfolio. Now, we do have a pretty solid opportunity to make a lot of this back in two ways. So first of all, through dollar cost averaging, we are buying $5 of this stock every day. So we have been lowering our average cost on this stock every day as it comes down. So, like this morning, let's see here when my last buy was. So this morning we bought it at $9.57, $9.86, $10.07. We've been buying this on its way down. So, if it evens out or if it starts going back up, that will help us regain ground quicker. The other thing that's important with this is their dividend is coming up. In a way, I'm actually excited that the stock is down because they're going to pay me 29 cents per share next month. And they're taking that screenshot of how much they're paying us on Wednesday. So on Wednesday, they're going to say how many shares, or based on how many shares we're holding, they're going to pay us 29 cents a share. If the stock price is still down quite low, it just means we'll get more free shares of MPW when they do that. So, I'm looking at the silver lining. I'm reminding myself this is a marathon, not a sprint. I'm just really, this is when it's tough to invest. I'll be honest. It's tough to look at a stock that you believe in, that you think is good, and you see bad press on it, you see good press on it, and it's your job to just make your own choices, do your own research. I think based off my personal research, MPW is still a good stock. I actually still like it. Some funds are buying it up in like $1 million of shares at a time. And that's what we look at. And then other people, in the comments, they're like, dude, you must be paid by MPW because you love it. And, MPW is the worst. And we just don't know yet. So, man, it's tough. This is a tough ride. Normally, I don't have a stock held as such a high percentage of my portfolio that's as like whimsical as this. This is definitely in the whimsical category, but it's a ride for sure. But we'll go back into the other stuff. I'll pull the rest of the stocks so we can look where our total losses are on those. All right, so back where we left off. AT&T, right? AT&T is actually like kind of holding it down, which is good. It's not very volatile right now. We've only lost $10.11 total year to date. We're pushing 13 shares, which is awesome. A $10 total loss so far this year that's actually pretty strong. So or Realty Income Corporation, they are down $31.13. Now, this position that we have, we don't put $5 a day into it. We put $10 a day. So the realized gain or the realized loss should be proportionately double to the other ones. SCHD is in the same boat, so this one right underneath. Anytime you have double the amount of money in an investment, your movement's going to be double, right? So it makes sense. So Realty Income and SCHD, which is Charles Schwab's dividend-paying ETF, both also pretty in line with AT&T. So, it says $31 down, but we've invested twice as much. So, it's a little worse off, I guess, than AT&T. SCHD, Charles Schwab's dividend ETF. This is down $25. Again, similar story. It's just down. Everything's down. JEPI, JP Morgan's Equity Premium Income ETF. That's not based off the NASDAQ like JEPQ, but they're very similar to one another. We're down $11.68 on this guy too. So just a lot of losses kind of everywhere you look. Procter & Gamble, this is like a miracle that we're only down $9.78. And this is why I love dollar cost averaging, because Procter & Gamble is also getting crushed. We'll pull that up in a second. Pepsi is I love the Pepsi stock. It's so good. The dividends are good. The returns are not as bad as other things. It's doing well and holding its own. And then we have BlackRock. BlackRock is getting just crushed. I mean, market price $636. When we started this thing, it was like 780. So it's down like 150 bucks per share. Not quite MPW levels. It's half as depreciated as MPW, but this is by far and large the second worst off thing in the portfolio. Like we're getting just annihilated with BlackRock. And actually, now that I think about it, NASDAQ, this position is only half of what BlackRock is, or half of what, half of what we've invested into MPW, I guess. These are like almost kind of proportionally similar. But anyway, yeah, BlackRock is just getting annihilated. They're a huge financial firm, and right now with the rate increases that are announced and the plan to get more rate increases, it's all the finance guys are just going to get demolished, which is good for us once we hit like September. So again, we're on this downward trend, right? We're going down, 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 down. But when the market bottoms out or whatever it does, right? Once it starts coming up, we're going to be buying it this whole time that it's coming down and goes up. We just don't have much time in the market in this portfolio. So it's going to look ugly. And I'm excited for it to look ugly because one day it won't look ugly. And that's kind of the goal with this whole thing. So thanks for being here while it's ugly. I appreciate it. But let's look at Procter and Gamble. So we're down at $9.78 year to date on Procter and Gamble. Let's take a look here. Let's go to 1 month. 1 month, it's just kind of bouncing up and down. Let's go to 3 months. So it's down 10.02% in the past 3 months. So our total return, we're only down 3.91%, which is way better than the average Procter and Gamble holder. So we're doing great. I'm loving that Procter & Gamble's coming down because they have a very long history of paying dividends. I talk about that. If you want to see why I pick these stocks, how I pick my investments and why, I have a video for that. It's towards the beginning of the channel when we started it, but everything there is still true to this day. But yeah, I mean, we're doing great on this. If my average cost is only $142.78, I'm lowering that average cost of per share every single day. We're really not doing that bad with Procter & Gamble. But Procter & Gamble otherwise, I mean, what was it at the beginning of the year? January 3rd, it was $151 a share, and now it's $137. So we would have gotten just completely crushed if we had just bought all of our shares at the beginning of the year. And we didn't. So that's great. All these little bounce up and down days, like we get it cheap here, we get it expensive here, we get it cheap here, and I'm cool with that. But that's kind of what's in the portfolio and what's going on there. All right, so yeah, I mean that's kind of the snapshot of what's going on. I would pour a shout out for my portfolio, but that's okay. Kind of just to talk about a little what's going on with the market right now. So in order to understand what's going on, we have to kind of understand the interest rate conversation and the Federal Reserve conversation. So I'm not an economist by any means. I just kind of watch the news and make my own inferences. And the best thing that we can do is stay informed. But, the Federal Reserve, they're basically the people in control of all the money, right? They print the money. They write the interest rates that people have to lend the money. They do all that stuff. Okay. So basically it's their job to control inflation, right? As we all know, the inflation in the United States is extraordinarily high currently. For those who don't know what inflation is, right? Imagine 2 years ago you could buy eggs for $2 a dozen. Now it's $7. Okay, that's inflation. Things cost more, right? If you want to look at it the other way, is you have the same amount of dollars, but they don't go as far. You can't get as much stuff with the same amount of dollars that you had from before. Okay? That's inflation. That's really bad. It's not good. It means one of two things. Either the goods and services are too expensive or the dollar's not worth anything. And we don't want the dollar to be worth nothing. So that's why this whole thing is happening. Basically, the Federal Reserve, the people who, control the flow of money, are saying that the dollar's worth too little. So they're going to raise the interest rates, which is making money more expensive to get so that they can get their money back. And it's making stuff really expensive. Think of anything. If you have a car payment and your interest rate's higher, it's going to cost more money. So maybe you buy a less expensive car, right? If your mortgage rate's really high, you buy a less expensive house. Same basic thing, okay? Now, what they're talking about right now in these Federal Reserve meetings are, we thought that we would be done with interest rate increases because they thought that the inflation would be on the downtrend, but inflation is still very strong. So basically, the bombshell this week was the Federal Reserve stating that they're going to not only continue to increase rates, but they're going to increase rates more aggressively, meaning that companies' money will go much less far, and it's going to be way worse than they thought. That's why we're seeing all these financial institutions, all these companies like MPW, who have a lot of debt, like just getting obliterated, right? So that's like scary thing number one, is just they're saying we're going to hike the interest rates, we're going to make stuff too expensive so nobody can buy it, and then the cost will have to go down, right? Supply and demand, if the supply stays the same but the demand is lower, it's got to cost less. All right, so that's scary thing number one. But the scary thing number two is that there was a conversation that, and this hasn't really gotten talked about that much, which surprises me, but the Federal Reserve is sort of like okay and kind of mildly expecting for interest or for unemployment rates to get to around 10% in order for inflation to go back to normal. And when the chairman of the Federal Reserve says, yeah, that might happen, just bluntly, that's terrifying. There is a high potential that the unemployment rate could skyrocket to nearly 10%. That is 1 in 10 people. So if you have a family of, 10 people, like, your brother's going to have no job. That is staggeringly high. And I think that has not gotten enough weight or enough, notoriety, I guess. People haven't, talked about that. But that's what they're sort of expecting. Like, they want the inflation rate to drop to between 2 and 3%, where it's currently at 6.5%. If they do that, they are predicting that to get to 2.5 to 3% inflation, that yes, it would cause a unemployment rate of around 10%. So if we have a tenth of our country, unemployed, unable to make money, and potentially on the verge of homelessness and stuff like that, because that's like 33 million people, like something like astronomical amount of displacement. And when people have so little money that a tenth of the population is unemployed, that's, you can only have so many Uber drivers. Like, if nobody's driving Uber, how are you going to make the money? Like, right now we have a gig economy. If you lose your job, you can drive for Uber Eats. But when no one has any money to pay for Uber Eats, you can't work for Uber Eats. So I think that's really scary. So, we're seeing that a lot in the market today. We saw it in the market this week, but Yeah, buckle up. I'm going to continue investing $50 a day into the market every Monday through Friday. That's the best way that I can combat this, because while the market's down, you want to buy, right? Buy while others are fearful. And do it as long as you can. And if you lose your job, don't sell it. Just keep it. That's the best thing you can do for yourself is just keep buying, um, and ride it out. It might take 2 to 5 years, but this is where millionaires are made, and hopefully we can do that on the channel. It's just scary because you have to be, a little bit of a diamond hander and just hold and not sell and keep buying while everyone's afraid. And it's a tough thing to do mentally to buy when others are fearful and kind of brave the storm, but works for Warren Buffett, so I think it's worth trying. Again, I'm not a wealth manager, I'm not a credit counselor, I'm not a financial advisor. I'm just a guy. But do your own research. Some of the stuff that I'm focusing on, like I just paid off $23,000 credit card debt. Right? I don't want that looming over me going into the month. I did that last month, and it feels great. And it's one less thing I got to worry about when the economy's down. It's important to make these kind of moves, and I don't think that I can out earn 26%. That's the interest rate on my credit card because of the rate hikes. So, those variable interest credit cards, pay them off and then invest again. Like that's an investment in yourself, so, if that's kind of my recommendation to myself is try to pay off as much unsecured debt as you can. I have no intention of paying off any auto loans right now because all my auto loans are significantly less than like regular interest rates. Like I could put money into a CD account, and it will out earn the interest rate in my car. So like, I don't want to do that because that's a bad allocation of money. How weird is that? That like having a car note is better than not. But it's just kind of a weird time. Like Jenna, today she was like, is the economy crashing? And she doesn't know anything about stock, like at all. And that's how serious it is. She was like, I feel like the economy's crashing. I was like, whoa, that's bad. Like when you have, she's smart. Don't get me wrong. She just doesn't follow this stuff. So when I come home and she's like, I think the economy's crashing. I was like, that is a bad red flag. Like you're a journalist. You are the other side of the brain. You're the creative in the household. So, yeah, really scary stuff. But hold the course. I decided to diversify into Pokemon cards, so maybe I can scoop up some good deals on some rated Pokemon cards while that market's tanking too. I don't know. We'll see. But keep your head up. Work on happiness, health, and wealth. Sorry you had to hear me sing at the beginning. It's just kind of the motto for the week. So going into next week, we hopefully should be doing a little bit better. I hope maybe some of this reaction to the Federal Reserve conversation gets kind of retraced back up for the positive. I hope people tend to be forgetful of massive conversations like 10% unemployment rates. I don't know how, but people have ADHD when they trade stocks. So hopefully we get a little bit of a rebound just so it's a little less depressing. Or maybe we see like one day of profit next week, maybe. I hope. But if not, whatever. We're buying stuff for cheaper. So with that, I wish you happiness, health, and wealth, and roll the outro.